The Dow Jones closed higher 7 days in a row and is on pace for its eighth straight positive day, as the S&P 500 also closed above 5,200, the S&P 500's highest level in over a month, as jobless claims for last week actually came in higher than estimates at 231,000 compared to 214,000. This leading indicator of weakness in the labor market boosts the possibility of economic weakening, which is something that the Federal Reserve wants to see, perhaps putting a more rate cuts back onto the table, which is why the Dow Jones and the S&P 500 have been doing so well recently. The Nasdaq has been lagging a little bit. We had poor earnings from Shopify, who had weak guidance, and Uber, so that pushed the tech markets down Wednesday and Thursday. But hopefully today on Friday, with TSMC's April sales report of 60% increase with the demand of their AI chips, because TSMC is a chip manufacturer. It's a foundry and makes chips for pretty much it makes chips for pretty much everyone, like NVIDIA, AMD. And if TSMC is seeing that increase in its AI chips, that's a good thing. So hopefully the market will react well today. We're seeing earnings per share are pretty much at their highest level and are up 5% from the year earlier compared to an estimates of 3.2%. So earnings per share is pretty much at its highest in over 2 years. So that's some good news. And next week we have our CPI inflation report for the month of April. That's coming out on Wednesday. And look, if it's in line with expectations, that shows that auto insurance might be going down, which is good news, and it could ultimately mean that the Fed is on path for more rate cuts, which is bullish for markets. So we have to watch that. And I also want to touch on a lot of people, some people are still saying that there's recessionary risks. And although that's possible, because we're starting to see some weakness in the labor market, and we had first quarter growth a little weaker than estimated, bull markets and economic expansions don't just die of old age. There has to be some kind of a shock event or an unknown happening to the market. Like in 2020, we had COVID. In 2008, we had the real estate bubble, and then the dot-com crisis. It was because stocks were melting up too far too quickly, and then we also had 9/11 that year. And 1982 was just really, really high interest rates. So bull markets and economic expansions don't just die of old age. However, by saying that, yes, there's a possibility, because with economic slowdown and interest rates higher for longer, that makes the economy and the markets a little bit more vulnerable for a shock to happen. But that doesn't mean a shock or an unknown will happen. So I just wanted to give my 2 cents there, because the betting markets lowered their probabilities of a recession this year it was very high last year. People thought there was a 70% chance of recession last year. Now this year, the betting markets are only saying there's like an 8% chance of recession. I still think the recession was the beginning of 2022, the first 2 quarters of 2022 where it started, and perhaps ended around October of 23 or March of 23 with the banking crisis. That's my opinion, but either way, we're seeing really strong earnings per share growth in the market, and the higher than expected jobless claims number should bode well for the markets in the next few weeks and months to come. Also one more thing. This is an election year, and historically the June through October period is usually pretty strong for stocks in an election year. So that's something we have to watch out for as well.